Hi, Marv Eisen here from Timeless Dollar. Don't trade unless you know your market. I made a video with that topic just a few days ago, and I want to follow up with an example of exactly what I mean. Now, this was the trading on December 10th, just a few days ago, and I laid out a few trades that, to me, seemed like good opportunities when they presented themselves. But for beginners and for novices, I recommend, the best trade I recommend is the gap trade, because gaps close 70 to 75% of the time. So that means that you have a trade that you can pursue that'll be successful 70 to 75% of the time. So that's a trade that everyone should have in their quiver. But I want to point out something about the gap trade, and if you don't know your market, you won't know how to play it. And here's what I mean. On December 10th, prices started out up here at about 46.99 or 4,700. And the gap was way down here at 46.66. Now, with the price action in the morning, up until, let's see, about 10:30, there was no way to know that this gap was going to fill. But at 10:30, the market declined. But still, there was no way to know that the gap was going to be filled. Because look, I draw a rectangular box on my chart every day. I calculate out, this is a calculation that I make every day based on Taylor's book method. It takes into account the highs and lows and where the market has gone from the low of one day to the high of the other and vice versa for several days. So that's a basic calculation that gives me an indication of where the market is going to trade on the following day. And it's generally pretty accurate, but it's still a pretty big range. Here, check it out. From 46.78 to 47.12. So that's a pretty big range. While I would like to say, gee, I would love to know that prices are going to trade up here at 47.10 at some point in the day, because if the market is trading down here and I know that the price is going to trade 47.10, well, gee, I'm just going to hop on and just be happy because I know that the price is going to hit. It doesn't work that way, and we all know that. But the gap trade does close 70 to 75% of the time. But there's a little bit of manipulation in here with the gap trade that you really need to know about. And if you don't know your market, you're not going to know about it. So here's a perfect example. On December 10th, the market came down to meet our support level based on the Taylor calculations at 46.78. Pretty accurate, right? It met support, bounced up off of it, and then came back down and went through it. So at this point, right about this point, we can see the gap is going to be filled, right? So great, we hop on, we're going to take the trade. Now here, right here, I have my cursor at 46.80. Now the gap is down here at 46.66. So that's a pretty nice profit. 14 points, right? So get on here, 46.80, write it down to 46.66. But look what happens. The market never reaches 46.66. The lowest it goes is 46.69, 3 points away, and then boom, it moves back up and away from the gap. So if you're figuring on trading the gap, I'm telling you, with the S&P Emini market, the gap is a very successful trade and a highly likely trade to be profitable. But you have to know that as the price marches toward filling the gap, it might reverse a couple of points before. At that level, hop out. If the price starts reversing when it's several points away from the gap, consider it's filled and take your profit. So it wasn't 14 points, it'll be 10, 11 points. Still not too shabby, right? On a trade that is successful 75% of the time. Anyway, that's my follow-up video for today on don't trade unless you know your market. And so now you know a little more about the gap trade and the manipulation that happens when the gap closes, because sometimes it doesn't close, but it closes. Anyway, thanks for watching. Trade safe, and I'll see you in my next video.